What if I told you that the largest wealth transfer in modern history didn't happen over years, but inside 37 minutes? No headlines, no emergency announcement, no vote. Just a quiet sequence of actions that most people never noticed, but markets did. This is not a story about volatility. This is not a story about inflation. This is a story about timing. And timing in markets is everything. The day everything changed. Let's start with the clock. At 1:23 p.m. Eastern Time, the Federal Reserve executed a liquidity operation. Not unusual on the surface. The Fed buys treasuries all the time. But this one was different. $47.3 billion in U.S. Treasury bills with a maturity of just 28 days. Not long-dated bonds, not routine smoothing, ultra-short maturity, highly specific, highly targeted. According to the theory, this was not a routine adjustment. It was an emergency maneuver, a signal. Why 28 days matter. Treasuries maturing in 28 days are not about investment. They're about cash flow. They are used when funding markets are stressed, buyers are disappearing, liquidity is vanishing faster than expected. In other words, when the system needs immediate oxygen. The allegation is simple but explosive, that the Fed was not stabilizing markets, but absorbing a flood of foreign selling that could not be allowed to hit the open market. Who was selling? According to this narrative, foreign central banks. The implication? If foreign central banks are dumping treasuries and the Fed is forced to step in as buyer of last resort, then dollars are being created to prevent a visible collapse. That part is not controversial. What happens next is where the story becomes unsettling. The 23-minute gap. At 1:46 p.m. Eastern Time, exactly 23 minutes later, a massive wave of buying hit global precious metal markets. Not gradual, not organic, simultaneous, algorithmic, surgical. The numbers are precise. $2.8 billion in silver, $4.1 billion in gold, $890 million in platinum. Across multiple exchanges, across multiple jurisdictions, all within minutes. Why this is not just a trade. Retail traders don't move like this. Hedge funds don't move like this. This was not chasing momentum. This was allocation. The alleged buyers? Foreign central banks. China, Russia, Saudi Arabia, and others. And not through public channels. Through coded institutional accounts that allegedly bypass normal reporting delays. The critical detail. According to the theory, these purchases were not paper trades. They were immediately followed by physical delivery requests, silver, gold, platinum, removed from Western exchanges, shipped to foreign vaults within 48 hours. That is not speculation. That is asset extraction. Why timing is everything here? As the key claim that these buyers acted before the effects of the Fed, ACE liquidity injection could ripple through the dollar. If you know dollars are about to be created, the rational move is to exchange them for something finite. Gold, silver, hard assets. If you act first, you buy cheap. If you act later, you pay the price. The core allegation, this is where the theory becomes incendiary. It alleges that certain foreign central banks received advance notice of the Fed's operation, not minutes after, not through market signals, but before the transaction occurred, through what is described as a multilateral liquidity coordination protocol. In plain terms, a private heads up. If true, this means it wouldn't just be insider trading, it would be systemic front-running at the sovereign level, a mechanism where foreign holders sell treasuries, the Fed prints dollars to absorb the sale, those same entities convert dollars into metals, physical assets exit the U.S. system over and over again. The feedback loop. This is the alleged cycle. Step 1, foreign central banks lose confidence in long-term dollar stability. Step 2, they reduce treasury exposure. Step 3, the Fed steps in to prevent a collapse. Step 4, new dollars are created. Step 5, those dollars are exchanged for physical assets. Step 6, assets leave U.S. vaults. The dollar weakens. The cycle accelerates. Why this matters more than price. Most people watch charts. This story is not about price movement. It's about ownership. Who holds the metal, where it is stored, and who controls access. Once physical assets leave the system, they don't come back. The silence. Here's what makes this story unsettling. No press conference, no congressional hearing, no official denial, just silence. Markets moved, vaults drained. The dollar absorbed the shock, and the public never noticed. The question. You should be asking if this happened once. Was it the first time? Or just the first time someone noticed the pattern? Because according to this narrative, this wasn't an accident, it was execution. And if the mechanism exists, it can be used again. If part 1 raised questions, part 2 raises consequences. Because once you see the pattern, you can't unsee it. And according to this theory, the pattern is already established. The smoking gun claim. Let's talk about what supporters of this narrative call the smoking gun. Not opinion, not interpretation, but structure. During the metals buying surge, the accounts executing the trades were not random. They followed a sequence. Allegedly labeled CN2847, RU2848, SA2849. China, Russia, Saudi Arabia, sequential numbering. That is not how independent actors trade. That is how pre-coordinated systems operate. In other words, these trades weren't reacting to news. They were executing a script. Why sequential accounts matter. In global finance, account structures are intentionally fragmented to avoid detection. Sequential codes are inefficient, they're risky, they're visible, unless visibility doesn't matter because permission already exists. That is the implication. The historical pattern. This wasn't a one-off. Supporters of this theory point to a 6-month historical pattern. Every major Federal Reserve liquidity operation was followed within 20 to 30 minutes by aggressive precious metals accumulation. Not hours, not days, minutes, over and over again, different dates. Same sequence, liquidity injection, pause, metal drain. The whistleblower claim. Here's where the narrative crosses into dangerous territory. Alleged internal communications, emails attributed to Federal Reserve officials, suggest a 36-minute advance notice window was provided to select foreign central banks. 36 minutes, enough time to position, enough time to convert, enough time to extract value. If true, this would not be incompetence. It would be policy. The most disturbing detail. According to the allegation, this protocol wasn't partisan. It allegedly operated under Democratic administrations, Republican administrations, a bipartisan continuity of action. That detail matters because it reframes the issue. This wouldn't be corruption at the edges. It would be systemic alignment between financial survival and geopolitical concession. Why would this ever be allowed? Here's the cold logic behind the theory. The U.S. financial system cannot survive a disorderly Treasury collapse. Foreign selling must be absorbed. But absorbing it publicly would trigger panic, so the Fed prints quietly. And in exchange, stability is purchased with real assets: silver, gold, platinum, a slow liquidation of the nation's balance sheet. This is not about morality. The theory does not frame this as good versus evil. It frames it as triage. Sacrifice the asset base to keep the system breathing, just not all at once. Gradually, quietly. Why precious metals are the target. You can't print silver. You can't dilute gold. These assets sit outside the promise-based system. That makes them dangerous and valuable. If you expect the purchasing power of fiat currency to erode, you convert early. If you expect inflation or systemic instability, you convert faster. The next window warning. According to the video's claim, another liquidity operation was scheduled for later that same day, $89 billion larger than the first. And if the pattern held, then another wave of metal accumulation would follow within the hour. This is where the urgency enters, because if the pattern accelerates, then the timeline compresses. The Vault Math Comics. Silver inventories, London gold inventories. They are not infinite. At the pace described in this theory, they would be depleted in weeks, not years. And when physical metal is gone, price discovery changes permanently. The real risk. This is not about missing gains. It's about liquidity denial. A future where paper claims settle in cash, physical delivery is suspended, ownership becomes conditional, where price no longer guarantees access. The binary choice presented, the narrative frames the moment starkly. Option 1, remain in paper assets. Trust the system. Accept dilution. Option 2, mirror the behavior of those allegedly closest to the information. Convert currency into physical assets outside the banking system. Not ETFs, not derivatives. Possession. Why this story resonates. Even if parts of this theory are wrong, the behavior is real. Central banks are buying metals. Treasuries are being absorbed. Liquidity operations are increasing. Trust is thinning. The system is tightening around its own contradictions. Final thought. This story does not ask you to panic. It asks you to observe, to stop watching the noise and start watching the flows, because wealth is rarely lost loudly. It leaves quietly, and by the time it's obvious, the window's already closed.